Are you self-employed? Are you 1099 and trying to get a home loan, but you're struggling to get approved? Stick around, this video is for you. Hey, what's up everybody? It's your mortgage expert here, Brian McCauley. So in my 16 years of doing home loans and being a mortgage advisor, about 30% of my clients are self-employed. Self-employed's always a very tricky thing. So first off, I want to clarify what self-employed is. Self-employed in my industry is categorized as anybody that is 25% or more owner in a business or anyone that is a 1099 contract employee. So self-employed can be tricky, right? The challenge with self-employed people, whether it's a Schedule C, an S Corp, a C Corp, whatever it is that a lot of times self-employed people make a lot of money, but their tax returns don't show a whole lot at the bottom line, so it becomes a challenging thing. I want to give you guys a couple basic breakdowns of how things work and how they're viewed from a self-employed standpoint, from a documentation and guideline standpoint, in order to put yourself in the best position possible if you are self-employed at 1099 to qualify for a home loan. You gotta be self-employed in the same line of work, hopefully the same business as well, for a minimum of 2 years, okay? So if you started a t-shirt company last year and you've made 20 million bucks, great for you. You can't get a traditional loan. There might be somebody out there will do it that's a private deal, but traditional home loans require 2 full years of being self-employed. Second tip, 2 years of personal income tax returns are required. Now, if you have a partnership, an S Corp, a C Corp, and you own more than 25% of the business tax returns are required also. So people say, well, who cares about the business? Well, we do, and I'll tell you why. Number one, if you have a business that has a brick and mortar building and you take $100,000 in depreciation on that building, that is a tax deduction that brings your taxable income down, but it's not a hard expense, so lenders add that back. The reason we get the business returns is so we can see that. We can't see that through the personals. Lenders want to make sure that all the partners are keeping all the expenses equal over the past few years to make sure that people aren't moving expenses around from one person to the other to make it appear like the person that's qualifying for the home loan has more income than they actually do. So let's get into the nitty-gritty fun stuff of how to understand this fully and try to put all this stuff together for you as a buyer. On FHA and VA loans, 2 years of income tax returns are always required. On conventional loans, 2 years is normally requested, but you can do a self-employed client with the most recent 12 months. If you had somebody in 2020 that was self-employed and they made $50,000 was their bottom line, and then in 2021, they made $100,000 in their bottom line, lenders normally want to take 2 years of tax returns and average that together, right? So you'd have $75,000 in income. That would be their income. That's about $6,000 a month. Let's say that $6,000 wasn't enough. If you do a 1-year tax return, which is the most recent at $100,000, you take that 100 and you divide it by 12, that puts that person at basically $8,000 a month. So now they go from income at 6 to income at 8. Well, a lot of times that extra 2 will give that person the extra buying power. So how does it all work? When can they use 1 year? When can they use 2, Brian? I want to know. There is no straight shot answer. It comes down to 2 things, really. The overall strength of the client, meaning good credit, good money down will give you the opportunity to do a 1-year self-employed tax return program. Worse credit, less money down, it might require 2, and then everywhere in between. So here's the evil side about home loans. I mentioned earlier, lenders normally want to have a 2-year history, and I used $50,000 for 2020. I used $100,000 for 2021. What if that's flipped? What if they made $100,000 in 2020 and they only made $50,000 in 2021? In this example, they won't marry the 2 together. They're going to use the lower, which would be 50 grand. People say, why? Well, there's what's called a declining trend of income. So if your income is trending up, you can use the 2 and average them together. If your income is trending down, they also want to know why your business has fallen off so much. So, hey, how come you went from 100 to 50, right? In theory, they can use 50, but they want to know why, because their thought is if you go from 100 to 50, you might go from 50 to 25 and 25 to nothing, and then you don't have any money and you can't make the payments. Part 2, I want to talk about tax deductions. So what normally happens on self-employed folks is they gross all this money and then they deduct all of their expenses. Hey, I made $100,000 selling t-shirts. I've got $75,000 in write-offs. I had, t-shirt costs, printing costs, employee costs, blah, 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 blah. So lenders never look at the top line, right? If your top line is $100,000 in sales, we look at the bottom line. It's called AGI, adjusted gross income. So if you made 100 and you wrote off 50 and your bottom line is 50, that's what a lender looks at for your qualifying income. Now, some deductions are not apples to apples. If it's not going to be a recurring expense in the future, it's possible that that expense could be added back, which would give you more income. So a lot of times there are hard costs that make your bottom line look like it's X, but getting the business returns, sometimes there are soft costs on there as well that we can add back that actually gives the client more income than what they're showing just on the bottom line. The last thing I want to share with self-employed folks is if you have delinquent taxes, if you haven't filed your tax returns, you got to get those filed. You got to get them recorded with the IRS. We will get transcripts from the IRS to make sure they match. If you owe the IRS money, you have to show that it was paid in full. If you paid in full, cool. We just get proof that you paid the IRS. If you're on a payment plan, cool. But we got to get what the payment is, and we have to make sure that you're actually sticking to the payments and you're not defaulting on them. Last piece, if you're self-employed, this happens a whole lot. Do not commingle your funds. If you've got $100,000 in a business account, leave it in the account. It is allowed, but we're going to do what's called liquidity test. We're going to make sure you're not borrowing too much of the business money. The reason lenders don't want self-employed people borrowing business money for a personal transaction is because those assets could potentially affect for the ability to the business to operate and produce income. They may need that cash flow for payroll, for expenses, and they don't want people taking too much from it because they're excited about a house and then all of a sudden they don't have enough reserves in the bank after they put the money down on the house, and it can cause hiccups with the business, which can cause hiccups with the income for the buyer, which can cause hiccups of their ability to make the payments. So listen, I know there's a lot to self-employed loans, but hopefully you found some of this video helpful or useful. If you did, do me a favor, like, subscribe. If you got a question about home loans or your self-employed situation, comment below. I promise to get back to you. In the meantime, if you just want to connect with me and set up a consultation, call me, email me, text me. Just know that I'm always here to help. Appreciate you guys watching. Stay tuned.